everyone, and welcome back to our Coldwell Banker Wealth Builder Expo series. I also want to formally welcome our friends and Wealth Builder partners at Guaranteed Rate Affinity Mortgage for their remarkable partnership that we have with them. And to everyone, however you got here, wherever you are, we are so glad you could join us today. And if by chance you happen to be joining us from one of the many states that are getting hit hard with the winter storms today, we're glad you're inside and stay safe. Listen, if we haven't had the opportunity to meet yet, hello. I'm Chris McGatt, Senior Vice President of Core 4 Engagement right here at Coldwell Banker. I'm confident you're going to really enjoy today's program. As we've said before, if you're in search of a proven way to grow and protect your personal wealth, well, you have definitely come to the right place. At Coldwell Banker, we're committed to going far beyond where most companies go. In fact, I believe that by working together, we can support you in building real wealth, something you can enjoy and leverage for years and years to come. Something we call living an exceptional life. And rest assured, we deliver on that promise of helping you live an exceptional life by staying laser focused on our core four: production power, coaching to confidence, an amazing culture of awesomeness, and well, why we're all here today, wealth builder. Now, just fair warning. If you're thinking that wealth building might just be a spectator sport, well, you might be in for a bit of a surprise. Here's what I do know. To get the most out of today's session, you've got to roll up your sleeves, engage in the content, and quite frankly, just do the work. Now listen, building wealth isn't hard, but it is serious business. And to be successful, it requires focus, commitment, and yes, self-discipline. Now, speaking of agent support and benefits for the independent contractor, don't forget that the federal open enrollment period is happening right now. This is the time to review your healthcare choices, reassess your needs, and select what's going to work best for you and your family in the upcoming year. Again, this opportunity ends this week on December the 15th for coverage that begins on Jan 1. But there is an extension until January 15th for coverage beginning on Feb 1st. So you got a couple different options there. Now listen, Coldwell Banker Realty proudly gives you access to two great benefit choices: Spark and MGA's voluntary insurance program, also known as a VIP program. Now, see the links in the chat for more information, or simply visit wealthbuilderexpo.com for all of the details. Now, speaking of discipline, if you haven't done it yet, please take the time right now to open an SEP retirement account. Now, remember, we make it super easy for you to save for the future with automatic closing deductions. Want to find out more about what a SEP account is, or how to open one, or even how to increase the amount that you're setting aside right now? Check out the link in the chat, or just go to wealthbuilderexpo.com for more info. Both of these will direct you to a site to schedule a confidential conversation with a SEP specialist. But do it right now before you get sidetracked by life, because it does happen. Listen, one of the things I like most about the Wealth Builder series is that we've created the perfect space to explore your personal finances and your goals. Now, this is a place where we can have open and honest conversations and discussions. And as you explore building wealth, I encourage you to stay and consider this theory of stay out of judgment and in curiosity. I think it'll serve you well. Now, imagine what could be possible if you had the support and you exercised discipline. The question is, how badly do you want to change the trajectory of your financial future? We've discovered that your journey to financial success rarely happens in a vacuum. And that's why we encourage you to invite your support team to each one of our Wealth Builder Expos. That might be your spouse, your partner, or for today's session, even your tax advisor. Financial success is a team effort. So be sure to get your team on the field with you. You'll be more successful if you're aligned with the people who matter the most to you. As usual, we're going to be recording today's session so you can review it in the future as many times as you'd like. Okay, let's get on with the show here. We've assembled a star-studded lineup for today's program. They're what I call the John Lennon and Paul McCartney of tax strategies. They hail from the great city of Chicago, and they represent the Manning Silverman Company, one of the top accounting firms in the country, specifically for independent contractors. For over 30 years, they've helped people just like us save money on taxes. And remember, every dollar you save on taxes is an additional dollar you can invest in your personal future. Please help me welcome Adrian Scartu and Joel Manning to the Coldwell Banker Wealth Building Expo stage. Gentlemen, thank you for being with us today. Adrian, let's go ahead and start with you.
Chris, thank you so much. It's really an honor to be here. It's become quite the great, end of year tradition. And I'm excited to talk about something I like talking about, tax strategy, but more so for the business owner and for the real estate professional. Why? Well, really because business owners and especially real estate professionals can take advantage of a lot of tax strategies that a lot of other individuals can't. So, in many places these days we hear and we're being told that we're living in unprecedented times. And although that might be true, what always comes to mind is something that John F. Kennedy said: the Chinese used two brushstrokes to write the word crisis. One brushstroke stands for danger, the other for opportunity. In a crisis, be aware of the danger, but recognize the opportunity. Now, we may or may not be in a little bit of a crisis right now, but it's a great time to reevaluate our business. When things are going well, everybody's excited and enjoying the fruits of our labor and enjoying our business. When things maybe aren't going so well, that's when we reevaluate. In reevaluating our business or just evaluating our business for the first time, it's important to understand the power that a business owner holds, especially as a real estate professional. And it's important to remember the discipline that small changes can have great accumulated results. Speaking of that, um, what if, and this has been our experience, that if, on average, we're able to save our real estate tax clients about $10,000 per year through various tax strategies. Now, if we take that $10,000 and yearly invest it in a SEP IRA or invest in some other account, after 10 years invested, that could yield about $200,000. Now, let's think about that. By understanding the tax savings opportunities that a business owner holds and using these to our advantage, not working significantly harder than we're working, but taking advantage of the tax code for our benefit, how would this additional, $10,000 a year saved help us greatly after 10 years? So, what are we going to talk about? Number one, entity selection. That's the big, controversy. Should you be an LLC? Should you be an S corporation? What should you do? Then let's talk about some commonly overlooked tax strategies. Hiring family members. You may have heard about it, but how can you really do that for your business? Retirement plans. The SEP IRA was mentioned. What about a solo 401k? There's all these retirement plans. What's best for you? Then I want to talk about Section 280A, which is one of my favorite, also called the Augusta Rule, that Inc. magazine named the number one most overlooked tax strategy for business owners in the country. So we'll talk about that and talk about how you could use that to your advantage. And I feel like every year there's a hot topic going around social media or just going out around the internet. And this year it's short-term rentals. Not so much short-term rentals, but also something in the tax world called the short-term rental loophole. So what is that? Maybe you've seen some videos about that online, but we'll really talk about that and dive into that some more. So number one, entity selection. Whether you're an LLC, or sole proprietor, if you look at your tax return, I hope everybody realizes one thing. All profits or net income of the sole proprietor or single member LLC, you pay something called self-employment income, which is really Social Security and Medicare income. If you were to have an employer, they would be responsible for paying half of that for you. But since you don't have an employer, you're responsible for paying all of that. And that's really 15.3%. So on all income of a business owner, if you're a sole proprietor or LLC, your profits, you're paying that additional 15.3%. Now, the reason I lump the sole proprietor and LLC together, because this might be surprising to some, but an LLC provides great liability protection, but from a tax standpoint, very, very little, almost no tax benefit. We may hear, form an LLC and you could write off all of these other things. Well, if you're a sole proprietor, whether or not you have an LLC, you can still write off or deduct the same amount of business deductions. Anything ordinary and necessary for your business could be deducted. So here's where the S corporation comes in, and here's why the S corporation could be a great tool for you. When you are an S corporation, you essentially set up a separate business. The LLC, you have the liability protection, but from a tax standpoint, you're taxed just like a sole proprietor. The S corporation, you now have a different legal entity that is the S corporation. And then you have you, the individual. So in your business, you now operate as both an owner and an employee. And here's why that's important. As an S corporation, you're able to pay yourself as an owner if you take an owner distribution, and also as a wage. The wage or your W 2, and I know it sounds funny, we own our own business, but yet we have to consider ourselves an employee, but it's an IRS requirement, right? So as the employee of your business, you get a W 2, and on that W 2, you're still paying Social Security and Medicare tax of 15.3%. As an owner distribution, those distributions you take out of the business, you're not paying that 15.3% self employment tax. So in this example here, we have a sole proprietor and an S corporation, both making the same net income of $100,000 or profit. Um, Federal tax is going to be the same. State tax is going to be the same for those states that have a state tax. But on the sole proprietor, on that $100,000, you're paying $15,300 of that self-employment income. On an S corporation, if you pay yourself $50,000 wage and $50,000 distribution, you're um, only paying that self-employment tax on the wage portion, on the $50,000. So in this example, there's $7,000, nearly $8,000 that we're able to take out without paying that self-employment tax. Now we might think, why don't we just pay ourselves $10,000 wage and take $90,000 distribution? Well, the IRS does require reasonable wage, and there's a calculation that each business owner should do to figure out what that is for themselves. However, by setting up the S corporation, we see here businesses earning $100,000 of net income or profits, that at the end of the day, a nearly $8,000 savings just by setting up the S corporation instead of the LLC. So number one thing that all business owners should talk to their accountant about is it right for me to be an S corporation? What's the threshold that I should make that switch? Because as we see, it's great tax savings, but also you have the great liability protection as well. So, hiring family members, another real hot topic. Now, how true is it that oftentimes our family members end up helping us in our business, right? So, should you formalize that business relationship with our family members? What should we do? What if you have a child or, in junior high or high school that will be going into college soon and you plan to pay for their college? Now, really, the tax deduction for making a payment to the college is not that substantial. And for some individuals, if their income is too high, they may get almost no deduction at all. But let's look at this. What if instead of paying the college directly, our children work for us who might be helping us anyway? So if they're doing legitimate work for us and have, a timesheet and all of that, we're paying our children. So we're at a higher tax bracket. Our children who might not have any other job might be at a lower tax bracket. We're not, might be, should be, right? So essentially we're shifting income from us at a higher tax bracket to our children at a lower tax bracket. And then something very interesting, any income up to the standard deduction, there's no federal tax due. The standard deduction is nearly $13,000. So let's say our children are in high school age and they have no other job and they work for us, maybe making $10,000 or $11,000 a year. We're able to essentially shift that income from us, pay our child that 10, 11, 12, $13,000, and we're shifting income from us to our children who don't have to pay any federal tax on that because it's below the standard deduction. And then what our kids could do is essentially, now that they have taxable income, they're able to take that money and put it in an IRA for themselves. So there's a study done that the sooner, obviously, the sooner you start putting money away into a retirement account, the more it accumulates. So I started funding my retirement plan around 25 years old, but I did some math that had I been 15 years old and started putting just 5,000 or 6,000 away to an IRA, by retirement age, just by starting the $5,000 to $6,000 10 years earlier, by retirement age, I should have almost $1 million more. Now, let's think about that. Not only are we helping our children um, develop some good financial literacy and financial management, skills, but we're starting their wealth building journey early. The other thing we could do is pay our children in high school or college and have our children pay their college directly. So we're not paying the college, the children are, but essentially, we get the larger tax deduction by shifting income from our larger tax bracket to our children's lower tax bracket. So really, it's a double effect here that we're saving in taxes by formalizing the business relationship with our children. And number two, we're able to employ this tax strategy to get a larger deduction for paying college. Now, since I mentioned retirement plans, another interesting thing I want us all to think about is I want everyone to start thinking about themselves as a business owner. What we might be comfortable with or what we might be familiar with is thinking about our 401k as an employee. So usually you could put away no more than $19,000 a year in an employee 401k plan. But being a business owner, you could set up a SEP IRA, you could set up a solo 401k, simple plan, and all of these other plans. So what's the benefit of that? A SEP IRA or a solo 401k, the max contribution you could put away is really $57,000 to $59,000. They kind of change that year by year, but let's call it $59,000. If you're someone who has, that cash flow or net income from your business, and you're looking at beefing up your retirement contributions, a solo 1K is a great tool. That we do have certain clients who set these up specifically to be able to put away up to $59,000 in your retirement plan. So again, what's the benefit of that? The contributions are tax deductible, so they lower your taxable income. And on the other side, you're able to put away a lot more money to retirement a lot earlier, so that starts accumulating as well. So again, the opportunity that business owners have is just the opportunity of many more types of retirement plans. So we really want to use these retirement plans to and know that we're able to put in a lot more money if we want to do that. So Section 280A, I mentioned that this is one of my favorite strategies, and Inc. magazine called it the number one most overlooked tax strategy for business owners, small business owners in the country. So here's what Section 280A is, also called the Augusta Rule, and here's how you could use it to your advantage. So it's called the Augusta Rule because around the golf tournament, what would happen is the golfers and the staff would go and rent houses along the tournament, and that was taxable income, and all of those homeowners got some lobbyists, and they said, we're not really in the business of being rental owners. We're just renting out for 2 weeks throughout the year. So Congress said, okay, if you rent out your home for no more than 2 weeks throughout the year, so no more than 15 days, so 14 days or less, if you do that, any income you collect, the rental income, is not taxable. So I could go out and Airbnb for 2 weeks throughout the year, no more than 2 weeks. So if it's 15, it's all or nothing. So it's not like, I could rent it out for 20 days and just claim the first 14 as non considered income. It's 14 or nothing. So I could go out and Airbnb my house for 14 days and then say, you know what, this is all tax-free income to me. I could do that, but also, who really wants to do that? Get out of their home and Airbnb their home, right? Well, how I mentioned, an S corporation. An S corporation is now a separate entity. What do S corporations do? Sometimes, and what do real estate agents do, right? Or what do most business owners do? You have meetings with other individuals. That's the nature of almost everybody's business, right? Or you might have presentations, or you might have board meetings or things like that. For your business, if you don't have an office, or even if you have an office, in order to have these presentations or meetings, you would rent a hotel space, a meeting space, a restaurant for half a day or maybe a full day, and pay that venue whatever you would pay them to have your meetings there. Now, because your S corporation is a separate entity from you, the individual, instead of your S corporation renting out that, you rent out your home. You have those meetings or your presentations at your home. So one thing you could do is do one monthly meeting where you have clients come and you do various presentations. Or you have one monthly meeting where you meet with your people you network with, or your staff, or your coworkers, or if your family members work for you, you turn that into a board meeting or some type of business meeting that everyone is involved. So you need a legitimate business agenda, right? You can't just claim this is a business meeting and we're going to be watching TV for 2 hours, talking about something else for another hour. So we have a legitimate business purpose. And now what we would do is, S corporations paying us, the individual, if you do that for no more than 14 days throughout the year, the S corporation again is able to shift income from the S corporation to the individual, and that income collected is not taxable income. So what we recommend is going out and getting 3 quotes and picking the middle quote from a meeting venue just to show that we're being conservative. So what if it's $2,000 a day for such a meeting? What if it's $3,500 a day? Or what if it's $5,000 a day? If it's just $2,000 a day, right, at 14 days, the business, your S corporation, could write a check for $28,000 to you, the individual. Your S corporation deducts that, so it's a $28,000 deduction. And you, the individual, you still report that on your individual return, but there's a way to do it to show that this is taking advantage of Section 280A and it's not taxable income. So essentially, you're shifting, in this example, almost $30,000 from your business to you, the individual, just by understanding the tax code and taking advantage of the opportunities that you have. The opportunities here are for someone who's already doing these meetings at a meeting venue, maybe do it in your backyard or at your house. Or for someone who's not currently doing these meetings, finding ways to have these meetings. And again, I think we would agree with Inc. magazine that this is a great tax strategy. It's definitely not something that's well known, and it's definitely something that everyone could take advantage of. And like I mentioned, it's just great tax savings opportunities for business owners. And finally, the big one that everybody's been talking about lately, the short-term rental loophole, or STR for short-term rental. Now, one of the reasons that many people go into buying rental properties is that you could cash flow positive from a rental property, but because of the tax opportunities of depreciation and other strategies, you're able to have a tax loss. So rental property, you're able to cash flow positively, but yet have a tax loss. So you might think, great, I have these tax losses for my rental property. So let's say I have a $10,000 or $20,000 tax loss for my rental property. I'm going to use that to offset my W-2 income. Not so fast. It's really, really hard to do that. In order to be able to take real estate rental losses against income from other sources, there's multiple tests you need to pass. Not an actual test, but multiple requirements that you need to meet. So it's very, very difficult. However, when you have a short-term rental, this is very, very interesting. Short-term rental is actually taxed a little bit different than a long-term rental. By short-term rental, this is just a rental where the average stay is 7 days or less. Does not need to be Airbnb. Could be Airbnb, could be VRBO. You could do this on your own and manage it on your own. But the interesting part about a short-term rental is that if you have a short-term rental, as long as you materially participate, which means you're showing that you're the one who's mainly operating it and there's no other individual managing it more than you, you're able to take these losses against your W-2 income or other source of income. And again, you just have to show that you materially participate. So this is the benefit of the short-term rental versus the long-term rental. And as we know, Airbnbs and VRBOs have been really, really popular these days. But there's another layer to this, something called a cost segregation study that maybe not many have heard about. So to give a very top level example here, when you buy a rental property, one of the great deductions that could help you have a tax loss but cash flow positively is depreciation. What depreciation is, when you purchase a property, the value of the building, not the land, you have to separate the land from the building. For the value of the building, you depreciate or write off over 27 and a half years. So let's say you buy a $500,000 property, out of which $400,000 is the value of the building. If you were to depreciate that over 27 and a half years, that's a $15,000 deduction every year, a $15,000 depreciation deduction, which is nice, but you have to wait 27 years to write that off. You can't buy a $500,000 property today and deduct $500,000. So here's the interesting part. With the cost segregation study, it's done by a team of engineers. So the engineers come in and they look at the property and they look at the building and they say, okay, the building is going to deteriorate unevenly. The roof has a life of maybe 7 more years. The walls have a life of 5 years. The internal cabinets, maybe 3 years. The floor, the carpets, it's a very detailed list, and they spell out the lives of all of these different assets, right, in your building. So what you do is that, keeping with our example, that $400,000 building, instead of depreciating it over 27 years, a lot of the assets have a much shorter lifespan. So with a cost segregation study, conservatively about 20 to 30% of the purchase price that's allocated to the building, you're actually able to deduct upfront year one. So in this example, instead of depreciating that $400,000 building over 27 years and getting a 15,000 deduction yearly, that's almost a $100,000 deduction year one. So what does that mean? That's really a $100,000 expense that you're able to use, and if it's a short-term rental, use it to offset income from other sources. This is a very, very top-level explanation. This is not very in-depth. Definitely talk to your accountant about this, or feel free to reach out to us, and we could help with this, because the cost segregation study is something that is a little bit more complex. But also, as you see here, mixing this with a short-term rental, you could buy a $500,000 property and deduct in this example, if things go according to plan, about $100,000 year one off the bat. So this is why everybody's been talking about these short-term rentals. Number one, because short-term rentals are really popular. And number two, you're able to do something very interesting from a tax perspective that you're not able to do with a long-term rental. And as a side note, this cost segregation you could do on a long-term rental and on a short-term rental. But like I mentioned, on a short-term rental is really where you're able to take the deductions upfront against W-2 income, let's say, whether on a long-term rental, you really can't do that. So as you see, this is definitely why this has become so popular these days. So really, I think we've tried to cram a lot of information in this short amount of time. We talked about entity selection, looking at the S corporation, seeing when that's best for us. We talked about commonly overlooked tax strategies, hiring our family members, looking at our retirement plans. We talked about Section 280A and how we could use that to essentially shift income from our S corporations to us, and also talked about the short-term rental loophole. It's not really a loophole because it's legal, but something very, very interesting for those real estate investors as well. And like I mentioned, I think we could see that there's a lot of tax strategies for business owners and especially for real estate, professionals. So going back to our example at the start, what if you could again save about $10,000 per year on your various tax strategies and on your tax liabilities? Investing that, how could that additional $200,000 after 10 years really impact your life? What can you do with that money? Maybe pay for a child's college, maybe take a nice vacation, have a lot more money in your retirement, purchase a rental property and do the short-term, loophole. So really, what I'd like everyone to take away from this is that understanding the tax savings opportunities that we all have and that business owners have, and being able to use those to our advantage. And now we talked about some of these strategies, and I want to hand it off to Joel so he could talk about how to implement some of these in real life and for our closing remarks.
Well, Adrian, a great job. And like Adrian said, there's a lot of information that he put into this short period of time. I would tell you, I've been working in this profession for 35 years, and it's taken me 35 years to almost master all the things Adrian just talked about. So what we really want you to do is lead with tax strategies, and we want you and your clients to really be able to benefit from this. So everything that Adrian shared with you, I'm going to try to just do a quick summary of how it really impacts you. Adrian did a really nice job of saying if you could save $10,000 a year, you'll have an extra $200,000. I work with many of you realtors here at Coldwell Bankers, and I have many of you who are saving more than $20, $50, and $100,000 a year. So if you could picture when Adrian talks about 200,000 at 10,000 a year, if we could start saving you 100,000 a year or even 50,000 a year, you're starting to look at $1 million or $2 million. And this is just really free money by just applying the tax strategies Adrian shared, like incorporating. You're a realtor, you make $100,000 as a sole proprietor or a single member LLC. Let's change it today. If you go out and incorporate today, that same $100,000 of earnings, Adrian or myself or your accountant, we can show them how, can help you to save up to $15,300 extra dollars. That's it. That's simple. You make more than 100, we can save you more. If you make less than 100, we'd save you less. But just using that 100 as our number. So there is no reason today to not literally go online, go to Google Docs, create your own incorporation, call our office, we could take care of it. Call your attorney or your accountant, they could take care of it, but act. Don't sit and wait till next year. Each year that we do this for you, we always keep listening to people go, I remember hearing you last year and we got to do it now. And I'm really happy when they're in our office and they're doing it now. But, each year it's money. Adrian talked about if he was 15 years old instead of 25 years old, how much money he'd put away. Hire your family members or consider having them as board members. You like your family, you spend time with your family, you go traveling with your family. How fun is it to be going to Nashville or Las Vegas or Disney World and having your corporate meeting while you're enjoying some family vacation time? The government asks you to put 50% business in. We all walk around with our cell phone. When you're sitting at a meal, have an agenda out there, take a picture of it, document which board members were there. and start having that corporate board meeting. If that trip you're taking costs 5,000 or 10,000, one of you over at Coldwell was telling me you're taking a trip over to Europe and you put away about $120,000 for this trip. Think about what we're talking about. If that's your corporate board meeting, the government's going to pay for $60,000 of that trip. That is a lot of money. Think about, as Adrian said, paying your kids. Somebody has 2 children, 4 children. You could pay them $12,540 a year. You get to pay no tax on that money and get the deduction, and they don't pay any federal tax on it either. What can they do with that $12,540? For many of us, put it away for college education. But for some of us who don't want to give our children money because we don't really like them, it's okay. We can give them the $12,540, put the money in a checking account, and guess what? They could pay us back. They could pay us back for food, clothing, medical care. So you could actually get your money right back and just enjoy the benefit of saving $12,540. It's incredible. These aren't things that, Adrian used the term of loophole. These aren't loopholes. These really are things that our clients and the people who are preparing tax returns are preparing them correctly. Think about a child who's going to college. I love the story of our clients who say, my children are going to the University of Michigan. It's $60,000 a year for tuition. They and their spouse make more than $150,000. $150,000 for a joint is a really magical number. When you fill out your FAFSA to send your kids to school and you make more than $150,000, you know what the government gives you? Bupkis. They give you nothing. You don't get a dime from them. But let's change that. Let's say you're that realtor and you and your spouse are making $220,000 a year. And you have 2 children in college. And as a business owner, you pay each of your children $50,000 each and let them pay their tuition. Now let's look at what just happened. We made $220. We gave each of our kids $50. So now our earnings are only $120. And guess what number we're below? That $150 number. There is a high likelihood we are now going to get money from the government for our kids for school. And even better yet, that child who's getting $50,000, remember what Adrian said before, the first $12,540 they pay no tax on. The balance they will pay at the lowest tax bracket, and they qualify for college credits. Where when you make over $150,000, you know how much of those college credits you get? 0. So let's get those college credits for you and get them for your family, because this is all about not how much money we make, how much money we keep. When you have those board meetings, your hotel, all your travel expenses, your meals are deductible. But think about something even simpler. How often do you go out to dinner with your family? We go out to dinner, and what do? I come home from a hard day of work, and what I really want to do is spend time with my family. And the last thing I want to do is talk about work. The first thing my wife wants to talk about when we go out for dinner is, how was your day? How was work? Right to work. Whether I want to or not, that's the subject matter all the time. So when we're out talking about work, how genius is this? We go out for dinner, we have a bottle of wine, our meal is a couple $100. Before it wasn't deductible. Now I understand some of you deduct it, but it isn't deductible just because you and your spouse go out to eat. But it becomes deductible if your spouse is on the board. It becomes deductible if your spouse works for you. So let's make those things happen. The only time I tell someone not to have their spouse work for them or not to have their spouse as a board member is one time and only one time, when they tell me they don't like their spouse and they're thinking of getting divorced. So if that's something that's going to happen, then what I just said, don't listen anymore. All right. But this is something that we should have a very good conversation about. The things that Adrian talks about that are so fun with a cost segregation study. You're a realtor. He is arming you with the greatest tool of all time. Every client that I have that buys a piece of property for substantially more than a few $100,000, we go into, and not a residential property, so I'm talking about a business investment property, we get a cost segregation study done. A cost segregation study that is done by an engineering company is generally between about $3,000 and $5,000. It sounds like a lot of money, but let me tell you and assure you it's not. What they do for you for free is they work up a whole scenario on that building you bought, which means they know if they're going to do this work for free, what you're going to get out of it is you're probably going to buy their service. And you will. Because what they do is if you bought that $1 million property and you depreciate it over 39 and a half years, you get to deduct 25,000 a year. But listen to what Adrian said. What this engineering company does is they come in and they show why every single thing in that building won't last 39 and a half years except for the land. So what they will do is they will speed up the deduction. So if you have a client who wants to make an investment, how great is it when they start seeing major losses that they can deduct in early years while they have out-of-pocket money and not pick up income? So a cost segregation, very important. My second favorite thing on earth for realtors is a 1031 exchange. Watch how fun a 1031 exchange is. I have property for $100,000 and a few years later it's worth $300,000 and I've now made $200,000. If I sell it, I pay taxes. I don't think you have to sell it because what we could do is we could buy something of equal or greater value. It could be one property or many properties. Now watch how fun it is when you become my age, all right? So for younger people, not as fun. For older people, it's a lot of fun. Now I buy the property for $300,000 and years later, I've now sold it for $1.1 million. What I've now done is I've deferred my gain. Remember, I originally paid 100. My properties today are now worth 1.1 million. I have $1 million of gain. Now I'm about to enter the last phase of my life, and I take that $1 million of property and I buy something of equal or greater value again. And now it's time for me to die. And I've now got $10 million of property that I originally paid $100,000 many years ago. That $9,900,000 of taxable income that I never pay tax on. Do you know what happens when I die? It's gone. They allow my heirs, whoever they are, my children, my wife, whoever I decide to give that property to, a step up in basis so that it's now worth to them $10 million. So if they go to sell it the next day for $10 million, no gain. If they sell it the next day for $9,800,000, $200,000 loss. So what we've done for them is we've really figured out a way where you can just build wealth. And I share with everybody when they say, well, Joel, that's a great idea. I just keep building wealth. I keep buying more and more properties. So someday I die and someday somebody gets it. What's in it for me? Well, there is something in it for you. It's called rental income along the way. And you probably live a very good life if you've been doing this all along. For all of us, we're talking about wealth building. There is two ways in this country to make millions or billions of dollars. One way is to be really, really smart with a little bit of luck and create a business that nobody else has done. Find a need and fill it. The other is all of you. You're in the real estate industry. There is no greater way to gain wealth than in real estate. I mean this. And it's easy if you start to apply the things Adrian shared. I hope some of the real life examples I've given you have helped. And then last but not least, I love to share this because this is my favorite. It's Adrian's too. It's called Section 280A, or as Adrian referred to it as the Augusta Rule. Think about what life is about. Life is about people. Nothing is more fun in life than spending time with people. You're a successful realtor. How did you get successful? Your customers, your networking people, your friends, guaranteed rate. Chris, Adrian, all these people made you successful. Have a get together at your home for no other reason than to have fun. But then, to top it all off, how fun is it when you can do something like we had a client do? We have a client against my better judgment, decided to buy an interest in a winery in Napa Valley. He owns a 10% interest. He was not making very much money off of it when his wife said, Joel, tell him to sell it. Instead of telling him to sell it, I had this crazy idea. He has a beautiful home in Scottsdale, Arizona, with a beautiful veranda. He lives on a golf course, and he's a member of the country club. And I thought, wow, how do I put everything together? So I put together a little letter to him, and it went something like this. Listen, Rich, what I think you need to do is start entertaining at least once a month. I think you should invite all your friends, all your country club, and all your neighbors. I think based on discussions with your wife, that's around 600 people to your home every month. Right now I know you think I'm out of my mind, but here's where we're going to go. We're going to interest all of your guests to come in and have some wine as much as they'd like, and try all your wines and have some cheese. So far, what am I talking about? I'm talking about Rich spending some money. Well, anybody who knows the wine business, the cost of all of that wine was hundreds of dollars, maybe borderlining on a couple of thousand. And the cheese was probably another couple of thousand. And then he went and got that proposal from his country club. What does it cost for an evening to have 600 people at your country club with some linens on the table, some flowers on the table, unlimited wine and cheese? And all of a sudden, guess what they told him? They told him $350,000 for an event. Well, let's think of 14 events. We're talking about $4.2 million. So every time you hear on TV how somebody like Warren or Bill Gates doesn't pay their fair share, this and real estate are the two reasons why. Just think of how creative you could be, but think about somebody like my client Rich, who is very lucky. He makes about $6 million a year, who in one little email that I sent him saves $4.2 million. And we've been doing this for many years now. We have never had any issues with the government on it, because it's really, when Adrian says loophole, it's really nothing more than the government has still allowed us to take this deduction. And when President Trump was in House, the conversation was he was going to get rid of it. He didn't. When Biden got in the White House, they all said he will get rid of it, and he didn't. And there's a reason, because you know who's using this more than anybody else? Our Congress people and politicians. So I just really wanted to say thank you so much for attending. Thank you so much for listening to us. I love sharing stories, so if I bored you with them, I apologize. But the greatest thing for you to do is just know that you are in the greatest profession, and it's the easiest way possible to build great wealth if you use some of the strategies today. Thank you again.
Adrian, Joel, thank you so very, very much. My gosh, so actionable, so much good information. I've got 4 pages of notes here. As usual, it's you somehow make the idea of taxes really interesting and really exciting, actually. Listen, this brings us to, quite frankly, my favorite part of the program, which is where we get Q&A from those of you that are joining us today. So remember, type your question into the Q&A box on the right-hand side of the screen, or look for the chat, or you all know how that kind of works. Just get us the question. But let's get rolling. Amy, go ahead and send over the first question, if you would, please. Okay. Let's start with this one. Can I rent a home office or bedroom under a sub-S corporation? I guess the question is, can my sub-S pay rent for a bedroom or an office in my house? Let's take it that way.
Sure.
Adrian?
So, excuse me. Yeah, there's definitely ways to look at this. If you have a home office, your S corporation is definitely able to take a home office. When you're looking at actually renting a bedroom as like an actual bedroom, we may not recommend that. But using a bedroom out of your house as a home office is definitely allowed, because again, it's your office. Where else are you going to work from? So there's definitely ways to do that. It's called an accountable plan. Your S corporation would have what's called an accountable plan to be able to reimburse you for the expenses of that bedroom.
Excellent. Ed sends us a real nice softball here. Oh, sorry. Sends us a great softball here.
Just
Go
making it
ahead.
really simple. If you choose the business to rent your home, it's a very simple concept. So first, my apologies for interrupting, but it's a simple process. You can pay yourself however much money that you deem fair market value. Let's just pretend it's $1,000 a month. And on your personal return, you pick up the thousand a month, but you offset it by all the various expenses for using your home, such as a portion of utility, a portion of taxes, repairs, and things like that. And so we can help you with that.
Excellent. Here's a softball from Ed. He asks, when is the most appropriate time during the year to change accountants? I need a new one. Do you work outside of Chicago?
So we work across the country and even outside of the United States. Um, my answer always is this: when you love your accountant, stay with him. When you think you don't love your accountant, the best time to switch is immediately. But this is a really good time because what you should be able to get is some really good year-end planning from whoever you switch to, and then get ready for tax season. But really, the right time to switch always is when you don't feel you're getting the right service. So whether it's us, whether it's somebody else, you should be able to call your accountant, get a return call within at least 24 hours. You should also be able to have somebody who's able to articulate things clearly for you, and make sure that they're giving you the time of day that you deserve.
Excellent. Um, Here's one. Just came in. It says, "Can my sub S corp give me a loan? How many loans can I get from my sub S? And how quickly do I have to repay those loans? And am I taxed on a lot of questions about that? Am I taxed on the loan?"
So, so you can take all the loans you want out of your company. When you take a loan from your company, if you're going to pay it back within 1 year, then there's no concerns whatsoever. You could do as much as you want, pay it back within a year of when you take the loan. If it's going to be more than 1 year, then what you need to do is recognize that there has to be some kind of interest that you charge. Now, as an S corp, it's going to sound so funny, but this is our laws. So you would charge some kind of an interest, and your entity, let's say, would be paying the interest to you. So they'd get the deduction, and then you'd be picking it up on your personal return, and you'd be picking up the income. So ultimately, it becomes very close to a wash, but you have to charge yourself some kind of an interest on that loan,
Okay. And it can
and
be
there's no
nominal,
deadline for when you
1%.
have to pay it.
Okay.
Correct.
Okay. Great. Question just came in here. It says, do I have to be an S corp to pay my teens? Or can I do that now? And then it goes on to say, Nicole says, how late in the year, like can I form a sub S corp in December and then retro it for the entire 2022?
You could
So
definitely
the
pay your
answer to that
kids at
question,
any time. Yeah, you could definitely pay
okay.
your kids at any time. So it does not need to be beginning of the year. It does not need to be regular. Could be towards the end of the year. Regarding the S corporation, whenever you incorporate either an LLC or an S corporation with the IRS, they would see that that's the date that it was set up. So if you have an LLC set up at any time throughout the year, you could convert that LLC to an S corporation retroactively. If you're not an LLC or an S corporation or anything at all, unfortunately, it would be from the time you set that up. So if it would be today, uh, let's say you're a sole proprietor, not an LLC or S corporation or anything, and you set one up today, unfortunately, the IRS would see that, and you can't put 11 and a half months worth of income and expenses in 15 days of the year.
Great
However, look at those
information.
last 15, however, look at those last 15 days of the year. And in those last 15 days of the year, let's say you wanted to do some of the things that we were talking about in the tax strategy, and in particular, setting up the S Corp. I strongly encourage it still because you start to save some of the self-employment taxes for the last maybe one or two commissions you're going to get for the year. I strongly suggest that some of the items that we've talked about, like paying your children, you can make the payment in that last 2 weeks of the year so that you can get the deduction for that as well. So just some food for thought. All the things we talked about, try to act on as soon as possible.
Excellent. Okay, so we covered this one from Betty. How about this one? You say that you can pay a child, uh, as a corporation, and that 12,000 and change is not recognized income, can you pay that to a parent?
Yeah, if the parent has no income and you pay them 12,540, same thing as paying a child.
Great.
So
Okay.
you would get the deduction,
Um,
and your child and your parent would not pick up the income.
okay, here's a question from Ed. Ed says, what is your opinion about what small businesses, LLCs, S Corps might expect with the prospect of 86,000 new IRS agents?
Well, this is my favorite subject. So we're hearing a lot about all these new agents. So let me put to bed what it means. When they said they were going to hire 86,000 new agents, remember 130,000 agents retired or quit. So there's really not a surplus of agents like everybody thinks. And then remember something else, that there's two programs that are going, well, there's three programs that are going on. One program was the stimulus checks that went out to everybody. One program is a PPP program, which gave people some money. And the third one is something called an employee retention credit for business owners that have employees that can get free money between now and July 24. IRS agents are overwhelmed with these three programs. They're so overwhelmed that agents in the IRS have decided to destroy IRS documents. If you haven't heard about it, I'm sure Adrian can share the story at great length with you because he's been involved with it, where they destroyed thousands of our files because they don't know what to do. They know they're never going to catch up. The amount of files that are in storage right now are just infinite. I mean, I don't want to tell you it gives you reason to take advantage of the IRS, but I do have to tell you, if anybody thinks there's going to be more IRS audit work, they're very much mistaken. If anything, it'll still be the same as usual. But I mean, their technology is getting better, which is good for matching things. But our read right now is, an office the size of ours, where we have many, many clients. We see, one or two audits in a year. I always like to say this to somebody: there is less than 1% chance that you will be audited in your life. So we cross our fingers together. But when I say that, think about it. If you live 100 years, there's a high likelihood you will never be audited, and that's how it should really be. So
Yeah.
don't let that be the reason that you don't do these tax strategies, because these tax strategies are the law. So we're not talking about things that aren't the law.
Sounds like they've got their hands full. A question came in about the cost segregation study. Actually, a lot of questions about cost segregation. One of the common ones was, though, who do I go to? Who does a cost segregation study?
Feel free to reach out to us. We have several contacts that work in all different states. We have a couple of referral partners. It is a team of cost segregation specialists. So if you want to start with Google, you can just Google cost segregation company. But we definitely have a number of referrals that we work with directly and that we trust.
Excellent.
And just to
A
share
couple
with you
questions.
how I was going to say, just to share with you how great of a program a cost segregation study is. So, like Adrian said, you could Google it, you could call Adrian, he can introduce you to some of the people we work with. But either way, you're working with a group of engineers. They're structural engineers that are trained to say what parts of your property won't last. When we are done, and when they're done with the report, it's a very detailed report, about 30 to 60 pages, depending on the building, and it will show you how much extra deductions you're going to get. At that point in time, all you have is this beautiful report that shows you what you're going to get, and it's free. They don't charge anything. This is what's so amazing about it. And then if you decide to go ahead with it, then what they do is they implement the hard part. The hard part is they put all the stuff together for the IRS for the tax return, but they do one step more. They get IRS approval on it. So when
Wow.
we're done submitting it, the IRS has approved what it is we're suggesting that they, or what they're suggesting we do. And so that's something that we really like for our clients, because now we know the IRS has already accepted it as well.
Excellent. On the same topic, we had a couple questions come in that center around cost segregation studies, commercial versus residential. Question here is, I own 7 short-term rental properties. can I do segregation on short-term rental acquisitions, and can I do it retroactively? I guess what they mean is if they bought this property a year ago in a different tax year, can they convert this over now?
Definitely. Yeah, you're able to do that. And then what they do is if you bought it let's say you bought it 4 years ago, you could have a catch up, meaning if you didn't do it 4 years ago when you bought it, and you should have had year one, two, three, and four, an extra $20,000 of expense every year, you catch up and essentially have an extra $80,000 this year. So there is that catch up provision. So definitely worth looking into.
Okay, excellent. And lastly, on this topic, Mike asks, is there a ballpark property value where cost segregation makes sense? For example, I just bought a vacation rental worth about 300,000. Is it still worth doing, or is there a certain number, like maybe 100,000 value property? It just isn't cost effective.
The cost segregation studies would tell you anything over 100. We generally say about 300. So the property he's
Okay.
looking at is generally.
Okay, good. Mike, sounds like you're in good shape then. Question comes in now based, kind of backing up a little bit on the idea of a sub S. The comment is I'm going to convert my LLC into a sub S tomorrow. I think you inspired someone, by the way. I want to bring my wife in as a board member or employee, question mark. So I guess what their meaning is, should I make them a board member or make them an employee?
Well, both choices are okay. So I would, again, like I said, I'd act and I would do one of them or the other. If you have an LLC, so for many of the people who are single member LLCs on this call, the fun thing is you don't have to do anything more than make an S election. So the cost is almost nothing. Once you're already an LLC, you don't have to pay to become another entity. All we got to do is fill out, it's a form 2553, making an S election. You can go on the IRS site and see it. You can call Adrian or myself. You can call your accountant. You fill out the form, and you've now elected your S status. Once you decide to do that, every year there's an annual report that comes out, and on that annual report, if it's a board member you choose, you notify the government, the state you're in, that you now are adding your spouse as a vice president of the company or a treasurer or a secretary of the company, and now they are a board member. If you choose to hire them, it follows all the same things we talked about today about hiring. So I like both. I like either. I just like people to get started with them because it's just silly to leave all the money on the table.
Boy, absolutely. Listen, folks, it is top of the hour right now, and I'm gonna call an audible. I'm gonna keep going as long as Adrian and Joel are game. Well, let's go another 5 or 10 minutes because I really want to make sure you get the answers to your questions. This is a unique opportunity. We are all in a very unique business, so let's make sure we seize the moment. Gentlemen, are you okay with that?
Yes, keep going.
Oh, you're the best. Okay, great. And our production team is nodding their head too, so I think we're in great shape. This is an interesting one. It says, can I purchase an RV, I assume recreational vehicle, wrap it, use it as my office, and then deduct any certain amount of the purchase price?
I'd say contact us for that because that's a little trickier. Everything you mentioned definitely can be doable. There actually is an IRS tax case that proved that just wrapping a vehicle, you don't automatically get a deduction. So that's another, commonly mistaken view that I'm just going to wrap my car or put my logo on my car or my RV or whatever, and it's a full business deduction. You definitely can use an RV as an office. We have other clients who do it. But again, just want to make sure that you're compliant with what the IRS requires. But again, doable.
Okay. While we're on the
So
topic
kind
of
of,
vehicles, oh, go ahead.
I was going to say kind of on the same thing that Adrian's talking about. Picture like for like dogs or something, like a little mobile car wash that comes up to your house and you bring your dog out and they shampoo the dog and they condition them. And if that's the type of business, yes. So really it's all about the type of business you have, and what is your real business purpose for it? Are you a realtor who's got an RV and you're sitting out in a parking lot 365 days a year moving around to different locations, having open houses and things like that nonstop? Or are you really just, you know, wrapped your car and it's really just your vehicle to travel on? So I think that's really what Adrian's alluding to talk to him.
Okay. No, that's helpful. Listen, while we're with vehicles, let me hit a couple more because we got a bunch of those. The question is, what is the heavy vehicle deduction all about? Heavy, quote unquote, heavy vehicle.
Sure. So that's another really hot topic right now. What the IRS has allowed the last 5 years, and something we've talked about in the past as well, that if you buy a heavy vehicle, so it's a vehicle over 6,000 pounds, you're able to deduct the purchase price immediately. So let's say you buy a $50,000, I don't know, Audi, whatever, Q7 this year. Instead of depreciating it over 5 years like more like small vehicle would, you get to write off that $50,000 deduction this year. However, caveat, 2022 is the last year you could take 100% deduction. Next year, 2023, it's dropping down to 80%. The year after that is 60%. The year after that, 40%, unless Congress steps in and changes anything. The one thing to be careful of, everyone talks about the great tax deduction. That car, if you write it off, let's say you buy that Audi Q7 right off that $50,000, you're telling the IRS the car is worth zero because you wrote it off. So 2 years from now, if you trade it in and get $40,000 for that, that's $40,000 of income to you because you're selling something or trading in something that you wrote off, so it's got a value of zero for 40,000. So it's important to talk to your tax advisor to see is it for you, because we definitely don't want to put you in a position that if you switch out your car every year or every 2 years you get a deduction, pay income, and then kind of have to go back and forth.
So I guess you can't 1031 a car then, can you? Too bad.
Yeah,
But now's a great time to buy that G wagon, right?
yeah.
Last question I'm going to ask you on vehicles, unless I get a barrage more that come in. This is coming in from Kansas City, actually. It says, I'm planning on buying a used moving van, wrapping the moving van and making it available to my clients who buy homes from me. What type of depreciation am I allowed?
If that van is again over 6,000 pounds, you could depreciate 100% of the purchase price this year. If not, it's depreciable over 5 years.
Okay, great, great answer. Um, okay, question comes in here. It says, what, this is interesting. I got a couple of questions like this. What are some of the myths of expenses that people think they can deduct, but they really can't or they really shouldn't deduct to cause a quote unquote red flag?
Well, I would begin with it almost in reverse. There is a myth that's going out there that says you cannot have a home office, and that is a falsehood. If you're a sole proprietor or a single member LLC, you can prove to all of your friends what I'm saying. Right on the form, it says, do you want to take a standard deduction for your home office or do you want to use your actual expenses? So think about that. You can deduct your home. There's only one thing you can't do. You can't deduct your home and then also rent it to your business for for 14 days or less, because once you're using your home 365 days a year, it violates that. So it's one or the other. And the only other thing I also want to kind of share with people when it comes to that home office deduction, if you're looking at me now in the monitor and pretending I wasn't at my home, but I'm not, I'm in my office. You'll see furniture. If you're looking at my office, I have a water cooler, a refrigerator, I have a TV. So the same thing goes for your home. When you're at home and you have that home office, and you have an armoire in your office, or you have a couch in your office, or you have some of these unusual things in your office, think about this. All of that's deductible. And just like Adrian said before about a cost segregation study having catch up, so does your business. If your business has never deducted your home office, all your furnishings and equipment, this might be the year you do the 280A, or it might be the year you don't do the 280A and we just deduct all of the items that are inside your office. So I strongly encourage that myth to just be that. It's a myth. Same thing if you're a sole proprietor. automobile mileage. You have a choice of taking the standard deduction, which is, Adrian, help me, 55 cents.
They just bumped it up to 62 now.
That's why I said help me. So it's 62 cents a mile, or your actual expenses. I mean, just think about that. If you're a realtor, most of us think about how we drive and we go, well, when I take my clients out, I drove 20,000 miles this year. I want you to think a little different, because the myth is, you drive your business miles. Where is your office? Is your office your home, or is your office at a Coldwell location? Once we decide where that location is, every time you're driving to pick up supplies, every time you're driving to look at real estate. I mean, one of the greatest reasons why I keep telling you guys you have the coolest business in the world. There's property everywhere and anywhere in the world. So we have a client who buys property internationally. And I say this because funny, it's a young couple. The two of them have combined income of about $250,000, and they have started buying properties all over Europe. And when they buy these properties, they Airbnb them or they rent them for periods of time. And they have lots of young friends that are, a good chunk of who their renters are. And I start laughing because I look at these people and I think they're going to Italy and they bought a property and they're going to Italy again. And the travel and the lifestyle they're living is really what I want some of you to think about. It's not for everybody, but it really could be for you. It's a great lifestyle to be seeing some of these properties. And in your business, every time you're driving, every time you're flying, every time you're looking at properties, my advice is take pictures. My advice is if you're traveling somewhere, stop in a realtor office. Just say, hey, I'm with Coldwell Properties, just interested to see what you have. Love to share a little bit about what I do. All of that will mean thousands and thousands of tax dollar write-offs when you write them off. Don't forget any of these things, because a lot of times whoever's preparing your return, if it's not Adrian, they're not used to it. So what Adrian's used to, because we do many, many, many realtors. I mean, I think right now we probably do a little over 800. When you do that kind of quantity of realtors, it's what we do. And we'll ask questions like, okay, so you say 20,000 miles, was that to show clients? What about picking up supplies? When you're on vacation, did you find yourself driving, looking at properties? Because sometimes those property ideas are great ideas for you too. You see something neat at a house, you take a picture. The next customer you might sell that house to, you go, hey, when I was traveling in, Delray, Florida, I noticed this property looked like this. Is this, you think, something that might be of interest to you? So try to think outside the box now. Try to think of, we have a whole world that we live in, and how can it benefit you?
I'm being overwhelmed with questions. I'm going to hit three more. We'll hit them fast. We'll wrap up. Don't go away. If you're joining us right now, we're going to give away some cool stuff at the end, show you how you could win something fun. But let's hit these three really quickly. This was a little bit complicated. I'm just going to read it to you. It's Amy from our live Facebook stream right now. She asks, I was under the impression that the CPA only does taxes following the rules and a tax strategist you consult with separately for tax strategies. Do you do both? I've never heard that before.
Yeah, so to
Well, my
answer
answer
that,
would be,
it depends. Sorry, it depends on the CPA. There's some CPAs who only do compliance work and who are not that well versed in tax strategy. But there's not an actual differentiator. There's a lot of great CPAs that do both. Our firm, we really do both. We focus on the tax strategy side of things, but we also do the compliance work, do the tax return. So that answers that one.
Super. Second to last question we're going to field here says, this is a 280A question. It says, if we have a meeting at home, if we have a meeting at home with my assistant for 3 hours, do I still get a full day towards my 14 or only 3 hours?
That would
so
still
each
be a
day,
day. They don't go. Yeah, it would still be a full day, whether you take the full three, full 8 hours, 12 hours, or part, which is why getting the most hours out of a day is the best.
Okay, great. And the last question I'm just going to ask out here is, does Manning Silverman do 1031s? I have clients needing this assistance from time to time, or do you refer that work out?
So we do the 1031s in-house. We have our own legal counsel in-house as well, so that can help when we're doing any kind of agreements or contracts. Again, you're welcome to use your own attorneys as well, and we work with them. And all of you who can't get your questions, and you can always feel free to email them to Adrian and I. We don't want anyone to miss out on any questions you have.
Right.
So
Right.
ultimately, we're here for Coldwell. You guys have been great partners with us, so we want to be great partners back.
Wow. Well, listen, let me just say to both of you, Joel, Adrian, thank you so much. We so appreciate you taking the time to answer so many questions. They just made the offer. We'll make sure that that contact information is in the chat. So if you've got a question that we were not able to get to, number one, I apologize for that. Number two, the good news is these gentlemen are offering to make sure that you get the answer to your question. Don't miss this amazing opportunity. Listen, just a reminder, additional information from today's session, a recording of the entire session, and other exclusive resources can be found at wealthbuilderexpo.com. And listen, we need your feedback on today's program. This is the third or fourth year we've done this. We've always got great turnout. It's always super relevant. This is no exception. But do me a favor, if you would complete the quick survey, we put it into the actual chat, so you can see a link right there. You can click on, you can actually take a picture of that QR code, but we want to get your feedback, and anyone that gives us feedback, we're going to throw your name in a drawing, and we're going to give away some amazing CV swag. Well, folks, that is a wrap for today's session, Tax Strategies for the Independent Contractor with the Manning Silverman Company. I'd like to thank the entire Wealth Builder team that made today's session possible. And of course, a great big thank you to Joel and to Adrian. But until our next session, I'm Chris McGatt, encouraging you to stay focused, disciplined, and committed to ensure that the best financial years are just around the corner. Thank you again for joining us, and be sure to fill out the survey.